Assalamualaikum and good morning to everyone and Sir Azwan. My name is Muhammad Zahri bin Muhammad Shukri, and today my partner and I will be sharing our insights from a study examining the role of ESG disclosures in shaping the financial performance of real estate firms. The article was published on 3rd August 2019 and the author of our article are Raisa Almeida and Asif Darmanshah. So without further ado, let's dive into our report. For starters, the investment landscape is evolving. ESG factors are becoming a cornerstone of decision-making, with firms increasingly aligning with long-term sustainability goals. This study focuses on real estate companies from G7 nations over a 5-year period from 2014 to 2018. While the findings are somewhat mixed, they underscore the growing importance of ESG transparency in ensuring resilience and fostering investor confidence. So if you look at the data presented in the article, the research analyzed data from 77 publicly listed real estate companies across G7 countries, the United States, the United Kingdom, Japan, Germany, France, Canada, and Italy. These nations were chosen because of their developed markets and influence in global financial trends. So the key financial metrics that were used include the return on asset or ROA, which measures how efficiently companies generate profits from their assets. Secondly is return on capital, indicating how effectively capital is employed to generate returns. And thirdly, stock price and price to earnings ratio, reflecting performance and investor sentiment. So, as shown in the pie chart, the US contributed the largest share of data at 39%, followed by the UK at 21%. This distribution highlights the dominance of North American and European firms in the real estate sector during the study period. So, moving on to the result and findings. Like I have said before, the research that was done produced findings that are somewhat mixed, but one thing is certain: the growing importance of ESG transparency is ensuring resilience and fostering investors with confidence. So let's dive into the first point, which is the overall ESG disclosure impact. So firstly, there are positive impacts. Companies that are transparent about their ESG initiatives tend to allocate resources more efficiently, achieving better returns. This aligns with the increasing investor preference for sustainable and resilient firms. Secondly is ESG disclosure boosts long-term confidence, especially in firms showcasing robust environmental or operational sustainability efforts. However, there are challenges. Some investors still struggle to see direct value in ESG transparency. For instance, many don't perceive ESG reporting as a factor that directly affects stock market valuations. Consequently, there is little to no observable impact on stock prices or PE ratios for many firms. This mixed reception suggests a need for better education and standardization in ESG reporting. So that is all for me. Now I will be passing on to my partner.
Assalamualaikum. My name is Muhammad Umar bin IZUDDIN and I will continue the presentation with ESG impact in environmental factor, which emerged as the strongest driver of financial performance. Firms with strong environmental commitment show improved return on capital and higher stock prices. Investors view such company as less risky and more future-oriented, enhancing their overall market confidence. For example, initiatives like reducing carbon footprints, adopting renewable energy, or improving energy efficiency signal operational stability and long-term competitiveness. In an era of climate-focused regulation, such commitment resonates strongly with both investors and stakeholders. Now, let's move to the social and governance aspect, where we can see no significant impact on financial performance. Social metrics like community engagement or employee well-being don't directly translate into measurable financial benefits. They often lack immediacy, making it challenging for investors to evaluate their short-term impact. Other than that, governance practices like board diversity or compliance framework are largely standardized in developed markets such as the G7. This means governance efforts don't provide significant competitiveness differentiation in these regions, which limit their impact on financial performance. Together, these findings indicate that while social and governance factors may not immediately boost financial performance, they likely contribute to a firm's reputation and long-term sustainability. To summarize, this study highlights three key takeaways. Firstly, environmental transparency matters most. Firms with strong environmental practices enjoy better financial outcomes, largely due to increased investor confidence and alignment with future regulatory trends. Furthermore, social and governance factors require further exploration. Their financial impact may not be immediate, but they play an essential role in shaping long-term resilience. Finally, ESG reporting benefits firms overall. Enhanced transparency in ESG practices helps firms attract sustainable investors and strengthen operational stability. The recommendation is clear. Regulator, firm, and investor must prioritize ESG disclosures, particularly environmental aspect, to foster both financial performance and sustainability goals. By doing so, we can ensure the real estate sector aligns with broader societal expectations. Thank you for your time and attention. I'll be happy to answer any question or hear your thoughts on comment on how ESG might continue to reshape the investment landscape. Thank you.